Let's start with Mastering Adjusting Entries. This is one of our 6 textbooks that we are using to prepare you for the American Institute of Professional Bookkeepers, the AIPB exam. Let's start by looking at cash versus accrual basis. Cash basis, the revenues are recognized when the cash is received. The expenses are recognized when the cash is paid. So very simply, cash has to change hands in order for revenue or expenses to be recognized. The accrual-based accounting, not tied to cash in the sense that revenues are recognized when they're earned, not necessarily when cash is received. Cash can be received in advance or cash can come later. Expenses are recognized when they're incurred. So once again, cash can be paid in advance of the expense or can be paid after the expense has been incurred. And expenses now are matched up with the revenue that they've helped earn. Here we have an example. The example is that in 2008, Pubco offers 2-year subscriptions to New Magazine for $20. That amounts to 8 quarterly issues. That's 4 per year at $2.50. So that's $10 per year for each subscriber. And it's a total of $20,000. Over a 2-year period, 20,000 divided by 2 will be 10,000. Now, it's $6 a year per subscriber, and that's paid at the time of publication. We have 1,000 subscribers. How do we know that? Take the $20,000, divide by $20, and that is 1,000 subscribers. So $6 a year per subscriber. So 1,000 subscriber, that will be times 6, will be 6,000 per year. Pubco also takes out a 2-year loan for $10,000 at 10% simple interest rate. Both the interest and the principal are payable at the end of 2 years. The principal is the amount of money that's being borrowed. The interest is the cost of borrowing the money, and interest is figured simply in this way of I equal PERT. Interest equals principal times rate times time. The principal is 10,000. The rate is 10%. The time, 2 years. So when you take 10,000 times 10% times 2 years, well, 10,000 times 10% is $1,000. Times 2 is $2,000 interest for the 2 years. Let's do a comparison here. We have the cash basis and the accrual basis showing for 2 years, 2008 and 2009. Cash basis, all the revenue is received for the subscriptions in 2008. So the full $20,000 is reported in 2008, 0 in 2009. Under accrual basis, we're going to report the subscriptions when we earn them. That means based upon when we deliver them. So we're going to deliver them at the rate of $10,000 each year. That's 20,000 divided by 2 years. So the publishing expense, though, is based on 1,000 subscribers at $6 per subscriber. So the cash is paid out in 2008 for those 4 quarterly magazines, and same thing in 2009. So it's 6,000 each year. And the accrual basis will be the same because that's the expense for the publications for that year, for 2008 and for 2009. So in this case, they're the same. The interest expense under the cash basis will be reported when it is paid, and that was the 10,000 times 10% times 2 years. So that's $2,000 will be paid at the end of 2009, and the expense will be 2,000 in 2009 and 0 in 2008. Under the accrual basis, interest accrues. So it accumulates, we owe it as time passes. So even if we don't pay it until the end of 2009, we owe a full year's interest, 10,000 times 10% times 1 year, or $1,000 in 2008. And then we owe the rest of it, another $1,000 for 2009. When you look at the profit, cash basis shows in 2008 $14,000 profit. Huge. But in 2009, a loss of $8,000. whereas 2008 and 2009 under the accrual basis each have 3,000. If you add that together, you find that accrual basis 3,000 and 3,000 adds up to 6,000. Under cash basis, the 14,000 less the 8,000 is 6,000. So it's the same. The total profit for 2 years is the same under both methods. What we have is the timing of those profits that are showing up different. Now, recapping. Cash basis recognizes revenues and expenses when cash is either received or paid. Accrual basis, revenues are recognized when earned, expenses are recognized when incurred. Therefore, looking at cash basis, the earnings are going to show up as you take the cash that you've received and subtract your expenses that you paid. An accrual will be the revenues earned less expenses incurred. Cash is irrelevant. Now, I do want to point out, cash basis is not accepted by GAAP, by generally accepted accounting principles. You need to be using accrual basis. Does it mean that we don't have some businesses, small business owners, small mom and pop shops that may be using cash basis? That's quite possible. But if you're a mid-sized to a large company that is publicly traded, they have to use accrual basis. All right, you are a caterer. The transactions you're about to see occur in March. What should you report as March revenues and expenses under? And we've got cash basis accounting, accrual basis accounting. So let's go through side by side, look at these transactions and see if they're the same or different. We have we prepay rent of $2,400 for 4 months. That includes the current month. So 2,400 divided by 4 would be 600 per month. Well, under the cash basis, we're going to go ahead and, since we paid it in cash that month, rent expense is $2,400, even though it's for 4 months rent. Under accrual basis, we're just going to record the rent expense of $600 because the other 3 months are prepaid. Receive $300 cash for catering services. Well, cash, we're going to recognize the revenue received because we've received the cash. Accrual basis, we've earned the revenue through catering services, so once again we go ahead and record $300 in revenue. Cater a lunch and submit an invoice for $1,200 that will be settled next month. Well, cash basis, there's no cash that's changed hands, so there's zero. Under accrual-based accounting, we've catered the luncheon, so therefore we've earned the $1,200. We will record revenue of $1,200, even though cash won't be forthcoming until the next month. Receive a $200 utility bill that you will pay next month. Well, cash basis, no cash changes hands, it will be zero. However, we've used the utilities. So under accrual basis, we're going to record utility expense of $200. Receive $1,000 from a customer for a function catered last month. Well, cash basis, we receive the cash, we're going to record it as revenue. Under accrual basis, we received the $1,000, but it's for revenue we earned last month, so we're not going to record it. It would have already been recorded last month. Receive a $500 deposit on a wedding you will cater later in the year. Guess what? We're looking at cash. Cash basis says we get $500. It's revenue. We record it. Accrual basis, we're not performing a service yet. It will be zero. All right, so take note of this because it's really important. You need to know if you're on cash or accrual basis. All right, looking at adjusting entries. Here are the principles of adjusting entries. Recognition of revenues and expenses is unrelated to the receipt or payment of cash. Cash may be received before or after the service is performed, or even if the goods are sold. Cash may be paid before or after the expense is incurred. Adjusting entries are used when cash is received or paid at a different time from when the service is performed, or goods are sold, or the expense is incurred. In 2008, Pubco offers 2-year subscriptions to New Magazine for $20. Once again, that's 8 quarterly issues at $2.50. So 8 times $2.50, that's where the 20 comes in. And they collect $20,000. So $20,000 total divided by $20 per subscription means we have 1,000 subscribers. Now, cash, debit 20,000, credit 20,000, revenue, or we debit cash 20,000 and credit unearned revenue for 20,000. Now, unearned revenue is a liability account. It's one of the few accounts that does not have payable in its name, but it is a liability. So we set it up there with the idea that if the subscribers, our customers, cancel their subscription, we have a liability there to pay them back for the dollar amount that they have not received subscriptions. Now, neither entry that we're looking at here records the amount of the revenue earned in 2008 on the accrual basis. And remember, this is dealing with $20,000 for the full 2 years. So in order to be looking at this from an accrual basis, we need to have the revenue for 2008 showing $10,000 because this is for 2 years. Half of the 20,000. So that would be 10,000. So we have these two options. We need to figure out how we can report this. So we need to have what is referred to an adjusting entry. So the adjusting entries will take and apply the accrual method to transactions when the cash flows and earnings, that's the revenue less expenses, are not occurring simultaneously. So accrual, cash flows after the revenue is earned or the expense is incurred. Deferrals, cash flows before the revenue is earned or expense is incurred. All right, we have accrued revenues, revenues that are earned, but the cash is not yet received. Accrued expenses, the expenses are incurred but not yet paid. So with an accrual, which is a type of adjusting entry, cash comes after, AA. Cash is after with an accrual. Deferral, we can have unearned revenues, the cash is received but not yet earned, and so we set it up as a liability. We can have prepaid expenses where the expenses are paid but not yet incurred. So in this case, cash is either received or paid in advance. Looking at this, we have Compco lends Zyco $10,000 on July 1 and will be repaid the $10,000 principal plus $1,200 interest on June 30th of the following year. What adjustment must Compco make on December 31st, its year end? So this is overlapping 2 calendar years. All right, so they're going to have to, the loan is made July 1 through the end of December, that's 6 months. and it is due and payable June 30th of the following year, which from January 1 through June 30th is 6 months. So we're talking about a full 12 months, a full year, and 6 months or a half year in from July 1 through December 31st, and another 6 months or half year from January 1 through June 30th. All right, so what we want to do is take the $1,200, divide by 12. That will give us $100 a month of interest. We can multiply it times 6 months, and between July 1 and December 31st, we have $600 of earned revenue. And so there needs to be an adjusting entry made to show that $600 of revenue, interest revenue, has been earned. And we do so by taking interest receivable and debiting $600 and crediting interest revenue for $600. So the adjusting entry, therefore, to accrue revenue is to debit a receivable of some type, therefore the blank, and credit some revenue. So in this case, it was debiting interest receivable, crediting interest revenue. Some other common accrued revenues would include commissions, royalties, and rent.